Hola, muy buenas tardes a todos.
Hello, good afternoon, everyone, and welcome to our fourth annual Investors Conference. I'm going to start by introducing the people who are sitting here with me. To my left is Sergio Fernandez Pacheco. He is a head of operations. He's a person in charge of technology and that we comply with the law at every single level that we are regulated at. It would be like defense, right? Head of defense. And then to the extreme right, Mr. Parajes, who is our partner, who is responsible for you understanding everything we do and withstanding the tough moments, the rules. It would be like the center field, like the connection between you and us. And to my right, Fernando Bernat, who is co-director of investments, together with me, responsible for the funds. We would be
Y se lleva los tomatazos cuando...
they are the ones who score the goals. And they are the ones who are to be blamed when things don't go well. Because Sergio and Beltran and the whole of the organization really don't make investment decisions. But nevertheless, when things go well, you cannot only congratulate the people who score the goals. You have to congratulate the whole team. And if you have any doubts, of course, about this, I will, answer your questions later. So we're going to give you a very brief presentation. We don't think we're going to make it short. We want to, but it'll probably take us more than 45 minutes. But we're going to try to make it in 45 minutes. And we're going to talk about 2 or 3 things that we chose this year for this conference. Fernando will talk about the portfolio later. Sergio will say a few things about regulations. Beltran will talk about the newest aspects. And we'll have 2 interventions today. That are Javier Santana, who is going to talk about our new managers fund. And we have, as every year, the participation of Jose Maria Marquez, who is going to explain the achievements of Azvalor this year. And we'll also show you a corporate video, which is 2 or 3 minutes long. So if we start with the results of our portfolios, the aim here is not releasing what has happened because you are aware of that, but it's, what we want to do is to to think whether we're on the same channel. Because in the world of management, everybody has doubts as to what it is to do it right. And let me give you an example of that some of you will remember. The Terra shares in 1999 were listed at 10 euros. And they left at 168 euros. They went up to 168. Well, from 20 euros, we didn't see any value in Terra. And yes, we lost from 20 to 168. That is by how much the share price increased. And then it went down to 1 euro and the investors lost it all. Now, the question is, what is it to get it right? There are some people, the ones that have more confidence and say, well, the getting it right is recommending buying at 10, selling at 168, and not wait until it goes down to 1. For us, that is not getting it right. It's beating the market on the long term. And it's important that we are on the same wavelength. So if we look at the outcomes of our historical investments, we started with 800 basis points, 8% a year. And the market did 6.5. We did 4.5, 15. And in this new phase, you can see it there in the Iberico fund. In 3.5 years, we got 17.5% more, about 400 basis points better than the market. And in our international fund, 9.5, which is about 300 basis points more a year. Now, we have done this historically, avoiding disasters. We haven't, really, scored huge things, but we've had to withstand being outside of, out of fashion, if you will. Avoiding disasters when they come and going up as much as a market or slightly less in a time of boom, that is how you get these returns. It is important for us to understand what it is to get it right. It's not defined by the fact that temporarily the market says we're right or that the people coincide with our opinions. Getting it right is when we know the facts about every company, define those facts clearly, have reasonable assumptions and a rationale that puts together the assumptions and the facts, and that should be healthy. And only if that is well done will we get it right. But I insist, not based on other people's opinions. In this process, we will get it wrong. We have and we will again. The explanation is that when you buy a company shares, you're buying the profits of that company at infinitum, and that company is an interaction of product, services, of a technique or the status of the technique, of competitors, of the regulator, employees, and every part interacts with all the rest and generate elements that are unpredictable by definition. So you can't avoid making mistakes or errors, but you can try to minimize them. So the conclusion is that being on the same wavelength, well, I want you to judge us by our long-term return. We won't be with the trending topics, with the terrors of this world. And now let's look at a reality that really called the attention of Fernando and myself because we were not aware of this. This is a graph that reflects what happens to an investor in terms of the historical maximum level that his portfolio has reached. It's done with algorithms. But what it comes to say is that faced with the recent maximum levels, the stock exchange is 2/3 of the time falling and 70% of that time with a fall of more than 20%. In other words, about 60% of the time, the person who every day looks at his or her investment gets a tummy ache. Is angry. And that because of human nature, and those of you who are married and have children will understand that we always try to blame somebody else. So who's to blame? The manager. So 2/3 of the time, you might feel angry towards your managers. But I did not know this, and now this allows us to understand it well and believe it. Understand why you're angry sometimes at us. And this, it's really tough seeing that 2/3 of the time this happens, but that has a reward. The equity securities award is 3.5%, which is a market risk premium. It's 3 to 3.5% more return than bonds. And that might not seem very much, but 6% to 3% in 30 years is multiply the money by 2.5 or multiplied by 6. And that is the reward of equity securities for those who invest in well-diversified fund. If we use the simile of a professor, we don't want our children to be quiet in the classroom. We want more things. We want them to learn. We want them to grow. And so what we want to do is to beat the market, which is something that only 6% of managers achieve. And they do so doing several things, but basically doing very few things, just doing the things they know how to do well, and doing things differently than others. So having portfolios that are not conventional and which might have a higher volatility. So if it's already difficult, the itinerary of equities is already difficult, but accompanying manager is even more difficult. And here your patience will be tested. We won't disappoint you in testing your patience. And in exchange for that, your attitude that allows us to do our job, because sincerely, if we didn't have patient customers, Fernando, myself, Michael, and myself, we don't know how to invest money to make money in the next 12 months. This is not the place for that, investing for the short term. In exchange of that attitude that you have, we come to an agreement with you. We create a club. It will be closed sometime in the future. We talk about 2.5 billion, and that will allow us to generate very good returns in the future. If we were to grow much more than that, it would be extraordinary for our net worth, but I don't think it would be so good for yours. And since this is very tough, the only advice that Bertrand and his team repeat constantly is don't try to look at it every day, because if 2/3 of the time it's going to mean a headache, well, save yourself that headache. And apart from that, invest money that you won't need in the next 5 years, so as to tolerate those market fluctuations. Now, very quickly, we're going to see what the world looks like. As always, as it always has. There's nothing really new to contribute. The world GDP always grows from 3 to 3.5%. The year that it doesn't, nobody can anticipate it. So it's, why waste your time trying to anticipate that? The estimated GDPs globally are 3.6%, which is quite enough to try to invest in global equities and get good returns. We don't waste time seeing what the GDPs are going to do, but in trying to forecast different elements of the economy. Like the simile I like to use, where a lake where there's a skater, if it's a very thin ice, then he might fall. We always try to see how thin the ice is on that lake to analyze the different aspects of the economy. And what we see is that nobody thought 7 or 8 years ago that all monetary stimulus that have taken place were going to happen. Nobody thought that Japan could have the central bank could have the ATFs. And since nobody thought this could happen, nobody knows how to get out of this. The problem is that economists and central banks tend to confuse, in my humble opinion, we'll see what Fernandez says about this, but they tend to think that the economy is like physics or maths, and it isn't. So when calibrating all the variables, the risk that there is that they're not in tune, that is a huge risk. But we're not doing physics here. But more interesting than talking about the macroeconomy is thinking what we can expect of our money today. Somebody who has money today, what to do with it? Well, the good thing about finance is that there are a few certainties that are a very good starting point. If you have money today and you don't know what to do with it and you want to think about the next 10 years, we'll see what you can get from the most safe element like the U.S. bond with a reserve currency, the most reliable currency in the world. Well, this figure that fluctuates every year is now at 2.7%. That is what a saver can expect in 10 years. After taxes, it would be 2. And with the inflation of 2%, if we believe it's 2%, some people think it's more, then it would be 0. If inflation would be a bit higher, let's say 4%, then in 10 years you get a certain loss of 2%. So it doesn't seem very attractive, and it might even seem dangerous. If you decide that you're going to tolerate 2/3 of the time going to bed with a headache, then you invest in an index fund of Standard & Poor's, let's say 300 basis points more than the bond, which is what is done historically. Now perhaps we can think it does less than that because the stock exchange has gone up quite a lot in the past 5-7 years. So keeping the historical risk premium perhaps is too hopeful, but let's say if that's the case, 5.6, which is 4.2 after taxes, and 2.2 after inflation. If inflation were 4%, there would be no return. If instead of investing in Standard & Poor's, you want to do better than that, and you get the top 1% of the managers, let's say you get 500 basis points more a year for 10 years, that would be being in the top 1%. That would be 10.5% after taxes, 8% after inflation, 6%. These returns are now reasonable, and if inflation were a bit higher, it would be 4% return. If somebody decides that they're so fearful that they're going to leave their money in a monetary fund very short term or in their current account, let's say nominally it gets 0, although it would probably be negative because short-term funds in some currencies are negative. But let's say it makes 0 after taxes. It's 0 with an inflation of 2%, you lose 2%. And if the inflation is 4%, you lose 4%. We have to be honest here too. We put a red star in the presentation, which means that this person has an option associated to that liquidity. And what is the option? The option that if, because it's very liquid, the market falls, it can go into the market at more attractive prices. Now, it must have a fast instinct to know that it is the right time to go in and then have the value and courage to do so. If he has both things, then liquidity has a value only in case the market crashes. But today, the commodities, which is the core of our portfolio, have a nominal implicit rate of 15% after taxes, 11%, and with inflation percent of 2%, 9%. If inflation were not 4%, the return would be 7%, which is multiplying by 2 in the next 10 years. So commodities, I'm sure you will be asking about this. I will show you a graph of why this is so. There's not much to it. Commodities vis-a-vis the stock exchange are 1 point something of 4% that they've had in the past few years. So this is what a saver today can expect. Then we can come up with theories, include real estate or art, but mainly what we have today is returns after inflation that are very, very tiny. One would think that commodities, which is the asset class where you need to be, will be well recognized by the market. And although the title of this graph might lead to mistakes, it's not that we have a portfolio that crashed and the C&P has gone up. It means that the prices of our portfolio now, which we bought where the red star is after the crash, if we take them from 2011, they have divided by 2, whilst the U.S. stock exchange from 2011 has multiplied by 1.6. We put 2011 because that's what monetary stimulus started. So if we take a base 100, stock exchange in the U.S. would be 160, in our portfolio 50. Therefore, we would be 5 times cheaper than the stock exchange, 3 times cheaper. Now, when when the price has fallen, when there are punished assets, most of the risk is outside.
As a matter of fact, all assets are subject to having risk. I don't know, problems in the mine. In the case of gold, there's idiosyncratic risk, of course. But when you have an asset base, and from that asset base, all pessimism has been purged in the form of a low price, the big risk reduction has already taken place. So with this, We just wanted to explain that commodities seem to be the most interesting asset class, and Fernando is here to tell us about all those commodities and all those companies where we have placed our money. Thank you, Alvaro. I will go over our different positions in the international portfolio, and then Alvaro will talk about our Iberian portfolio. But we're going to spend some time here, so please bear with me because I believe it's worth it. Our collection of assets in our international portfolio until under the custody of our teams and the prices at which we have bought these companies are a very good investment opportunity. So, like I said, bear with me. Let's start with gold. Well, gold has a weight of 17% in an international portfolio. First of all, we need to understand the context. We're talking about an industry here in which the index has dropped by 85% since its maximum points in 1985. This behavior has nothing to do with the stock market, and it has dropped far more than the raw material itself. So this is an industry that nobody wants into right now. This industry is doomed for many, and some of the large investment funds, some of the largest funds in the world, consider the gold sector as non-investable. It's ruled out. So this huge traumatic crisis, of course, as you can imagine, has caused a deep readjustment process in the industry, leading to important cost adjustments in all companies, mines shutting down, companies going bankrupt, and even lately, a huge consolidation process that's actually very interesting because the companies that had the weakest management teams, the ones that did worst, are going into the hands of the strongest people, the strongest, best managers. And we believe there's something positive to see here, and yet the stock market does not seem to appreciate that to the extent that we've been able to buy the best gold miners around the world at very interesting prices, even with no need for the price of gold recovering. Our assets and our iron ore and our gold ore portfolios are very good, and we like them at the level where they are right now, well below the $1,900 per ounce we had in 1985. But beyond that, we have a particular affection for gold. And I know it's a controverted debate, and there are famous value investors who devote a lot of time to explain why investing in gold is not rational. So sorry to be so vehement, but I must say I do not agree with Warren Buffett, because gold is money, and it's good money. In contrast with fiduciary money or human money. And we shouldn't lose sight of the long-term evolution of these types of money. If we go back to the strongest currency, the world reserve currency, the US dollar, in 1918, that's 100 years ago, you could buy 1.550 grams of gold. 20 years or 100 years later, you can only buy 20 grams. So the dollar has lost nearly all of its value in the past 100 years. So it's a long-term trend. And of course, you might think that 100 years is too long a stretch, even if the trend is uncontrovertible. But what do you think about gold right now at a midterm, 5 to 7 years? Well, that's precisely what we like about gold right now. The circumstances under which the global monetary system are right now and the global circumstances are a hot cocktail. Think about this. First, we have witnessed the largest amount of money printing in the main central banks around the world ever. Since these banks were funded and they reached the present point with X amount of money, they have tripled the money that had been printed until then. Second, Our present maximum situation of debt over GDP is at global maximums. We have more debt than ever, particularly in the Western world. And at the same time, there's also a Western record of off-balance debt coming from all these promises we've made about pensions, health, and education, precisely at a time when we're facing the most important demographic challenge in our history due to the growth in the world population. And third, for this cocktail, we see budget deficits in all economies despite the uninterrupted growth of certain economies in the past 10 years, and despite the fact that the cost of that debt has reached minimum lows. It's never been this low. At points, it's been even negative. So imagine what would happen to budget deficits if interest rates changed abruptly now. So I believe there's a will by all public powers to generate inflation, and more than a need, more than a wish, it's a need to generate inflation to exit the debt trap where we are caught. And under these specific circumstances, we firmly believe that gold acts as some sort of insurance vis-a-vis inflation acceleration risks or a monetary chaos that seems very interesting. And we're not even paying a premium for it, for this insurance. As an example in our portfolio, and it's a very clear example, I believe, we have the Buenaventura Mining Company, our main asset in our portfolio. Although we're making 40%, this is still the #1 company, and we believe it still has a great potential. And it's 70% below maximums of 2011. And this company has a share in the Cerro Verde mine, one of the best copper mines in the world. And only that fact justifies the $4 billion it's worth in the stock market. So that equivalent million ounces they produce every year in their other mines comes for free, practically. So in this case, we have nearly free gold when we're buying Buenaventura stock. And it's under the control of the same family that founded the company back in the 50s, a family with great value, always growing organically. Very unusual situation in the mining industry. They have sorted out the most difficult circumstances, like, for instance, those times when Peru had to go through hyperinflation during Alan Garcia's government or term. So this clearly reflects our investment in gold, and we also hold 17% in the oil industry. And I believe I'll skip the oil industry for the moment and leave it for the Q&A time, because it calls for a more complex analysis. And I don't want to take too long right now. But for now, do consider that there's an exaggerated pessimism around the oil industry. Assuming only $65 per barrel, we're buying low-cost producers at 6 times profit. For instance, another important position in our international fund, which is the London-based company, or Tullow, it's yielding 30%, but it's coming from maximums of 16 pounds. This company produces mostly in Ghana, with a cost below $30 per barrel, with a solid balance and a management team that are frankly doing things very well. Plus, they have other important projects in Kenya and Uganda up their sleeves to add to their value. So much for the oil industry. Copper, 12% in our portfolio. I will elaborate on that. Copper as a metal is the synonym for economic growth, urbanization, industrialization, increase in consumption, and certainly power. Not only in the traditional sense, but right now when we're trying to use renewable energies and power cars, etc. And copper has been growing at nearly 4% during almost 200 years. And I would say that the future despite oscillations, will look just like the past or even better. Much has been said in the debate about the risk of a supercycle in China. But remember that the copper stock per capita in China is but a fraction, 1/3 of that in the West. And if we look at yearly consumption, which does seem higher in comparison with developed countries, there's nothing extraordinary about them, particularly for the development moment China is going through with an urbanization of only 50% versus an average in the West of 80%. There are examples in history during which countries that were aiming to become world superpowers, consumption reached about 20 kilos per capita, which is much higher than China has right now, slightly exceeding 8 kilos per capita. So we believe that China will continue to consume a lot of copper in the future. And those 2.53 billion people who are barely in the picture of the copper market in China are no match for those in the rest of Asia, Africa. Well, an evident example is India. Only 20% of the power consumption in China, which in turn is but a fraction of consumption in the U.S. And with a per capita copper stock that is 1/3 of what China was when it was in the same situation India is right now in 2002, 2003. This is just to show the potential consumption of copper in the future, and that's why we feel so reassured with the long-term possibilities of copper. And that's only on the side of demand. And it so happens with commodities that the interesting side is on the side of supply. Well, copper is a scarce mineral. It's an objective point of data. If we compare the proven reserves of copper in the world in comparison with the world production, these are some of the lowest numbers in all commodities. So out of the top 10 mines around the world, because this business is highly concentrated, only 2 out of the most important 10 are discoveries made in the last part of last century. So it's very difficult. It's very unlikely that more copper will be found in the world, and only a couple big mines will go into production soon to compensate the depletion of the ore in the present mines. So this material is becoming increasingly more expensive and more difficult to mine. If in the past you needed a deposit of 3 to 4 concentration of copper to mine the ore, right now they're considering deposits of 0.4. An increasing number of underground mines rather than open mines, and also increasingly stringent environmental requirements. Ultimately, throughout history, there are bursts every 20 to 30 years of important productivity steps, but there's no significant step in the foreseeable future. Think about automation and electrification and the high relevance that heavy machinery has acquired in the past. There doesn't seem to be another important leap in terms of productivity increase. So we have to replace 25% of the world copper production between 18 and 23. And this will call for a huge investing effort, which is precisely the opposite of what we've seen in the past few years, which is an important drop in investment. So this trend needs to change dramatically, or we will see important changes causing a large increase in the price of copper. I already mentioned one of our investments on the copper side, but we also have Grupo Mexico that you have heard about in our previous annual meeting. This company has dropped by 45% from its previous maximums, and they own the best copper asset in the world because they own the lowest cost mines in Peru and Mexico and the best reserves, and we're buying them at 6x yield, assuming slightly above the present value. Company, this one is also in the hands of a family, the Larrea Mora Velasco family, with a huge tradition of value creation and a very solid balance. We believe that they are worth more than twice their price in the market. And so much for copper. There's also uranium that I will also skip because as an industry we have discussed it sufficiently, particularly in our latest quarterly report. But we were also working with the largest and best companies in the world. Our main investment in uranium is the Pacheco mining company, with some of the best uranium mines in the world, 2 in Canada, 1 in Kazakhstan. There's also almost 70% below previous maximums. A company with no debt, quoting at 8 times profit, and giving us some very positive surprises. Always very reassuring. So that was uranium. And next, let's talk about carbon, because we also do invest in carbon, or coal, which is probably the most berated material of all. But we still need to consider that coal still accounts for over 40% of the power generation around the world, along with natural gas, another fossil fuel. And even if it seems incredible, in 2018, the demand for coal grew by nearly 6% last year. Obviously, in the countries you can imagine. These are not Spain or Germany, but India, Bangladesh, Vietnam, etc. And up to a certain point, it does make sense, doesn't it? Despite the environmental damages, coal is the cheapest form of energy, a very abundant material, and technical coal facilities allow for huge amounts of energy in the development of countries. And we invest in the absolutely best coal mining company in the U.S. In the U.S., the story is slightly different because in the past 10 years, this industry has gone from 1.2 billion tons to 1.8. And of course, this comes from the closing down of mines and the lack of investment. Not even a cent was invested in the past few years in the United States, and therefore production is dropping at the same pace or faster than other ores. And during this time, Consol, our company and portfolio, has growth in production. At least on thermal coal, they've gone from 21 million tons to 28, because they're the best coal miners with the best mines. The Pennsylvania Mining Complex, it's high-quality coal with the very good properties. And beyond that, they have the best possible management team in America. Most of their top management are 35 to 40 years seniority in the company, and it's just a pleasure to hear them talk about the way they make their decisions, considering value creation for their shareholders. So their corporate culture is admirable at all levels, because although in Pennsylvania most coal mines are trade unionized, in Consol not only are they not unionized, but also they have a monthly bonus based on safety, production, and cost improvements. So that's very unusual for a mining company. And here we're buying at under 4 times EBITDA and with very little debt. And we're talking about present profit with no adjustments at present prices. So you can imagine that even if coal seems to be a no-no for most, for us, it's almost an irresistible asset. And with this, I close, and I leave you with Alvaro again so that you can hear about the Iberian portfolio. Okay, so much for the international portfolio, which has been very clearly explained.
The Spanish portfolio is very concentrated. It is still a collection of our best ideas, with 67% in the top 10. It's a good business portfolio, 12.5%, which is a 10 times profit. We see a great potential in it, And what I wanted to remind you of this portfolio is that in this complex ecosystem where many parts interact that I mentioned earlier, we know Spanish better because we know the assets, we know the executives of the companies, we know the directors of their boards, we know their culture well. So I wouldn't forget about Spain. There are 60 or 70 companies that you can invest in, including Portugal, and so we know it better. And even so, of course, we can make mistakes, as we will see in the Q&A, but the mistakes in the Spanish portfolio are less and less costly. I'd like to give the floor to Javier Santana so that he can explain his new enthusiastic project. Please, Javier. Hello. I guess that some of you will wonder what this fund is that we've been talking about for some time. The fund is because there are many interesting areas to invest in the world where Azvalor cannot reach. And so we want to choose a limited number of managers and invest in their best ideas, put them in one single fund, and offer that fund to investors who want to co-invest with us. It is not a fund of funds. I want to make that clear. It doesn't invest in other investment vehicles. It invests in companies that have been picked by each one of those managers. And that's important because the main advantage of that format is that we can have access to any manager in the world wherever he is and in whatever structure he has. This allows us to access the jewels, small managers. I'm not going to define what criteria we've chosen because it's in the slide. But if you look what brings them all together, it's the criteria that we demand for ourselves. We're asking for Azvalores in the world. We spent lots of hours to each manager that we assessed. Now the fund has 4 managers. Let me give you a few ideas on each one of them so that you know who they are. First of all, Donald Smith and Company. Donald Smith was Benjamin Graham's student, who, as you know, was a father of the value school, the intellectual father of Warren Buffett. He's been managing since '81 with his right hand, Richard Greenberg. They are a company that basically invests in small and very small American companies. And then Moeros Capital, Admi Vawani founded this company. He came from a very prestigious company in the U.S. where he worked with a legendary manager who died a few months ago, Martin Wiltman. And he founded this company with 3 former colleagues who came from Third Avenue. Thirdly, Guerin and Rosenberg Management Company. They're experts in companies related to natural resources. The most senior of the 2 has been managing exclusively funds in this area since '91. His parents met each other in a refinery. They both worked in Exxon. So that's where it all came from, his passion for this industry. And lastly, but not the least important, Mitram and Brades, a company founded by 3 brothers. Chris started to, well, he has 30 years of experience. He started to manage in the 30s for some customers. And at the beginning of the decade of 2000, some colleagues insisted that they create a fund structure to invest in. And since 2002, he has been managing in that structure very successfully with spectacular returns. In terms of the portfolio, it's quite well diversified geographically speaking, also in terms of the size of the company, and invests from very small companies to very large companies. And it has a revaluation portfolio of 126%, taking the potential of each one of the managers. We launched the fund in November of last year. Initially, we put the minimum investment of the Azvalor funds were launched in 2015. The fund has been welcomed by the investors. We are not finding any operational problems, and we have decided to bring it down to 5 billion euros and 500 million for under 23 years of it. So we make it affordable for those who want to co-invest with us. And I say co-invest because about 25% of the fund's assets come from the investments of the Azvalor employees, because we want to invest for us and our families what we invest for you. Thank you.
Muy bien. En cuanto a
In terms of the activities in 2018, if we talk about entry flows, entry of capital into our funds, the most interesting thing is to see whether what Alvaro said at the beginning of his presentation, if there is consistency between our investors, and we can say with pride and satisfaction that for the third time in a row we've had good entries of capital. We've had 82 million euros of net entries. This is net. 82 million, which is 93 if we take into account only equity funds. We have an equity fund where 11 million euros decided to leave, and I guess they went to equity funds, and also number of investors, 1,300 new co-investors. So we have more than 18,000 now, and we're still growing in that universe of investors. And we want a model of proximity, direct communication with our investors or the advisors of our investors. With those 1,400 one-to-one meetings that we had in 2018, where we've included a new initiative that I recommend to you all if you don't know it yet. If you have the chance to see it, it's Café with Alvaro and or Fernando. On a weekly basis, we organize a meeting with 6 or 8 investors, usually 3 or 4 who invite somebody else to learn about us. And it allows us to have direct contact because you trust the management team that has a face, eyes, and ears. And it's great to get to know them and ask your questions. Although we have this meeting, but of course it's not face-to-face. And we continue to collaborate in something that we think is essential to improve our investor base, which is a financial dissemination. We have Azvalor U with many visits, many hits, but we also participated in the Complutense summer courses in Madrid, as I say, the Complutense University. It's a summer school. And we published some books. This one is for younger people, The Secret Club of Millionaires, with 26 advices from or tips from Warren Buffett, or this book from Howard Marks. Well, we want to disseminate financial culture. And apart from these books, you will find in your documentation some information, and you can even buy the book on your way out of the meeting. Now, in terms of news about the funds, we don't have much on this slide because we're never going to have too many products, but we do try to improve the accessibility of our clients to our different investment funds. Luxembourg, we've replicated the Azvalor Iberia that we have in Spain. Also, the Iberian blue chips. And we're going to replicate it in Luxembourg, the blue chip one, because there's a greater interest now in Azvalor after 3 years of experience. And last year, together with Azvalor managers, we also announced the launching of the Ultra Fund, and we have a national version of that fund to give access to our investors to this fund. And the last part that I wanted to mention is coinciding with our 3 years of existence in Azvalor. We have reviewed our corporate image. We've renovated our corporate image. We discussed internally our vision, our values, that Alvaro will say a few words about at the end, which is summarized in that message of shared value, because all of you represent 50% of the success of our investments. Sergio? I am going to focus, as on previous conferences, and try to summarize very briefly the things that in 2018 and beginning of 2019 are affecting operational, technological, or regulatory aspects that are affecting us. Firstly, and starting with, as we did on previous years, 2018 has been a year of a lot of activity. We've processed more than 16,000 deals. The investor care or service department answered 7,000 calls. This is a first point of contact of investors with Azvalor, so it's critical for us. And also maintaining a high level of quality. We've only had 3 incidences which have given rise to claims, which is less than 0.02% of all the processed deals. 2018 also was a year that was very intense on the web. We had more than 1,700,000 hits or visits from 472,000 users. Last year, there was a lot of dynamism in generating content for our YouTube channel. Beltran mentioned it. It's Azvalor U, and it had more than 226,000 views with 3.6 million minutes in total that were viewed. And in the past few quarters, we also accelerated the digitization of the company. The most obvious project in this regard was a change of web. The previous one was from 2015 when we started with the Azvalor project. And after this short period of time, 3 years later, we thought there was a need to change our web page, and we the new one. It's more intuitive. It allows for better access from different mobile devices, and it does give you a much more efficient platform to manage videos and images that we use more and more of. This digitization process is not an end in itself. What we want with digitization of our processes is basically 3 things: to reduce costs, to improve the efficiency of a company; on the other hand, to reduce operational risk; and the third and most important objective is to improve the user experience, your experience when you use our platform. And an indicator that we like to follow is that of additional operations. These operations can be carried out completely with a digital signature, and right now more than 90% of operations in funds and pensions are being signed digitally. That means for the company a lot of cost savings, reducing operational risk because we reduce manual intervention, and obviously ease for the investor because they don't need to print or deal with physical documents. We also worked or continue to work on facilitating long-term savings, which is a strategic aim for us, improving with it by improving efficiency, improving recurrency and accessibility. From the point of view of recurrence, at the end of 2018, we made available to you a new functionality, which are periodic contributions in mutual funds. This new functionality, unlike pension schemes, are not carried out through an addendum. You need to do 2 transactions, one with us, with Azvalor, signing the regular underwriting order, indicating the amount you want to invest, and then with your bank, you need to ask them to do a regular transfer for the same amount that you signed with Azvalor. From the point of view of accessibility, 2 things I want to remind you of. The reduction we did last year of the minimum investment amount for young investors, less than 500 euros. And then we have the Azvalor managers. This the minimum was 40,000, and now it's available to go into it with 5,000 euros, or 500 if you're under 23 years of age. And lastly, this is part of the DNA of the financial business and the asset management business, and that is the need to adapt to the regulations, which change so often. Two regulations I'd like to mention: the European Directive on Financial Instruments Market, MiFID II, which was transposed in January 2018, which has had an impact on many aspects of the business in the distribution part, and also the factories for a greater transparency and cost information that must be given to customers before and after signing the contract. And then we have the data protection law, which was fully enforced in May 2018. This does not require transposition as directives do, and that has entailed changes in the systems, processes, manuals, and in Azvalor we are fully adapted to the requirements of these two sets of regulations. And that is all I wanted to say. Any new thing regarding these aspects, we will of course keep you posted through our quarterly letters or through emails. Thank you, Sergio. Now we're going to hand over to Jose Maria Marquez, who is going to tell us what we finance and what we're doing with Azvalor, because he allows what we do to go beyond, so that people who, apart from the money, get something else in return. And this makes us a bit more human too. Jose Maria, please, it's up to you now.
Thank you, and good afternoon, everyone. As Alvaro Guzman usually says, investing hurts. But it can feel like childbirth even. After a period of bearing, you come up with these smiling, beautiful savings that allow you to have a better life. So each and every one of us, when we think about those savings, we tend to think about others too. Others, as in our loved ones, helping our parents, paying our children's tuition, or if you're Bible readers, or if you think about what to do with your talent, you may be thinking about yourselves, doing something great for yourselves, doing something meaningful, so that your time in this life will leave a trace when you're gone. Well, that's what opportunities like the ones Azvalor allow us to achieve. We don't only think about money, we think about projects. During this year, 2018, the first full year when Azvalor has been working from beginning to end, we've been present in 11 countries, as you can see on screen, with 30 different projects with an average of 30,000 euros per project, health, education, water access, always with the commitment that 100% of the investment reaches destination. We are a team, well, obviously, Azvalor does not charge any fees to launch these projects. What Azvalor does is to contribute their teams and allow their teams and anyone who is interested to invest in these projects. But anyone in the project, everyone else in the project work pro bono so that this investment can reach these projects in 100%. You can see, for instance, this is a small school in South Sudan. You can read about these projects on the social media because we tweet about our projects, and many of those projects are also retweeted by Azvalor. You can read about them in Azvalor U, and if you're curious, you can contact us via your manager in Azvalor or via our website. In the previous slide, I don't know if you could see these girls, but I don't know if you know it, but these are the first students in the Wino boarding south of Tanzania. We built a high school thanks to an Advalor project. And thanks to this project, the girls in greater need actually get scholarships to attend this school. So this is one of many projects of Advalor investing in the future. So when we think about how everyone can do something, this missionary sisters were only a few months ago celebrating the beatification of two of their sisters, two sisters who were murdered in Africa several years ago. So they're really giving it 110%. They're part of the team, but they're the ones who run in the foreground to help change the lives of those who need it the most, and putting all their skin in the game. A few weeks ago, the person or our contact that produces sunscreen creams, first in Tanzania and now in Malawi, was telling me that only a couple of weeks ago, a couple of albino people were murdered in Tanzania based on these horrible rights that they have locally because it is considered good luck. But actually, the big killer of albino people in the south of Africa is the sun. So thanks to this project, we get this life expectancy that is below 20% average can actually be extended. This child will probably, or this father will probably outlive his child. And that's what we're trying to prevent with this sunscreen project. Since I appreciate Alvaro so much, I've tried to overstep my time to make sure that his forecast of us not being in time would be fulfilled. And if you have any questions on how to continue to support the Davalor project, you can contact any of our friends or myself. Thank you very much for everything we have achieved this year, and we have a very big Christmas list for next year. We hope we can count on you to achieve that too. Thank you.
Muchas gracias, José María. Vamos a ir terminando.
Thank you, José María. We're close to wrapping it up now, so I would like to stop right now to think about our values. Well, obviously, every company have their own values. We just don't believe that our values are our marketing principle. Our values come as the answer to a question. Why only 6% of asset managers can beat the market? And our answer is, at the same time, part of our values. We believe that most asset managers cannot beat the market for three fundamental reasons. The first one is because most managers do not risk much, do not take risks. As you could see in our first presentation, there is a very clear connection between the fact that you invest in your own fund and the fact you don't. The second reason, why don't more people beat the market? Well, because it's difficult. That's a very simple reason, but this is a difficult business. So, thanks to our principles, the first being excellent, not just calling ourselves excellent. We want to be excellent so we can beat the market. And since this is a difficult task, it seems it works best as a team. So you need a flat horizontal relationships. And third, beating the market is difficult because it puts you to the test. And it highlights your errors and your failures, and you need to manage that. So we articulate our principles as follows. If you don't chance it in your own funds, if you manage funds but your money is not in them, you're not risking anything. We invest in the same funds you do. So we are taking the same stakes as you are. So we do have skin in the game. We cannot promise any results, but we can promise you that we share your destiny and your destination, because we do have skin in the game. And this has implications throughout the whole chain of company and processes we have. And our second principle, since the market is difficult, we need to be excellent. To be excellent, you need to learn constantly. You need to be demanding. Our analysts are permanently under the microscope, under observation. Next year, we will be here with our head of managers who will explain that we all need different skills and we each contribute our own. And this is a premiere. We're now, or all of our investments have the go by Michael Assalem, our associate in London, with different skills to ours, which come to complement what we do as a team. That's the second principle, excellence. And to be excellent, we need a team, and we need to learn constantly. And the idea of team goes back to what I said at the beginning of the conference. We absolutely need to comply with the legislation and help you understand what the legislation is about. And without our teams, we couldn't be doing what we're doing. I know this sounds trite, but it is a fact. Without our teams, we couldn't be doing what we're doing. So when you want to integrate a team into your values, there's a lot of commitments you need to adopt. And third, you need to be humble. Not that we're particularly humble anthropologically. Maybe we could do better on that front, but at least we're modest enough to understand that the world is a lot more complicated than newspapers show. We know that very few people know what is going to happen, and at least we're humble enough to admit that, if only because for the past 20 years we've been failing from time to time. You know that what you know and what you don't know is not what kills you. What kills you is what you think you know for sure. And to be excellent, sometimes you just have to say, I don't know. You need the courage. You need the humility to say, I don't know. We have a small group of investments that we do under the mind in the room of the I don't know. And obviously you need to be humble enough to admit your errors, to acknowledge your failures, and try to draw the lessons from those errors. So if you are still wondering about what it means to have skin in the game, excellence and humility, those are the necessary conditions to beat the market. So Beltran, if you agree, I think we could play the video. Well, before that, yes, sorry, I needed to make that announcement and I forgot to do it. You have an interaction card in your welcome material where you can write your questions. We have a couple of questions from our online audience. So, well, we barely exceeded the allocated time of 1 hour.
Sencillo en la teoría, pero en la práctica implica algo mucho más complejo porque
How can you tell the real value of something? As individuals, our valuations are subjective, and as such, can we conclude that something has a specific value? Society needs conventions, tools that will assist global consensus on the value of things. But is price the same thing as value? The time factor is fundamental to reach this balance. Society tends to efficiency, but it takes time to reach efficiency. In Azvalor, we see quality businesses managed by honest and skilled agents with a deep analysis of companies and their competitors, knowing that stock prices do not always reflect intrinsic value and that sooner or later the market will show what the real value is. And it's not a matter of value of intelligence, but it's a matter of hard work and experience. Our managers and analysts have been investing our customers' savings for 20 years with full dedication and independence, establishing a connection of co-investment and putting skin in the game. We want to grow, but we want to grow healthily. We seek well-informed money, tending for the long term and resilience. And this takes total disclosure connections with strong interdependence with our employees and our investors. Without these connections, our investment just could not happen. Analysis is a very important part of our philosophy, but so are other areas. Excellence is the sum of all of our skills and concerns. We are proud of the human team we make. Good teams become great teams when each member of the team trusts their co-members so that they are convinced that there is no I in team. We share the same values, and thanks to our team spirit and to our internal communications policy, we've been certified best workplaces of the Best Place to Work consulting company. Our team is our best investment, and we use all the resources we have to take care of it. Be a part of our mission. We want to give something back to society. In Azvalor, we believe in creating value as a means to improve our environment. The ultimate goal is giving. These are our values. Azvalor, a value manager with values.
Muy bien, pues empezamos con las preguntas, como ha dicho Álvaro.
Okay, we're taking questions now. As Alvaro said, we already have some questions coming from the social media and some of your written questions. The first one, in the present environment of a slowdown in Europe, political uncertainty in Spain, could we provide some suggestions for an investor who wants to stay with our funds? Well, as we were showing in the first few slides, I believe we need to understand where expectable return lies today. And during the present uncertainty, I believe that commodities are our safe haven. I will go into deeper detail now and see what Fernando has to say about it. In economy, most exchanges occur at a certain term. Most of them are short term, like a lease or a salary, or your insurance premium. Other exchanges are longer term, like a mortgage or a state bond. Just as most short-term promises are fulfilled, long-term promises are more difficult to fulfill because it's more difficult to estimate what's going to happen in the next 30 years. And until those 30 years have elapsed, it's very difficult to know whether your mortgage is worth less or more than your home. I remember during the Spanish real estate bubble, people found themselves with a home that was not worth as much as their mortgage. And that's important in economy because all long-term exchanges are always a little bit up in the air. So in that sense, liquidity or a treasure fund is the third leg in an exchange where the state has or is an invested part too. I don't remember who this quote is by, but someone said that there was a time, or the quote is, all states have failed at one point or another. So if you're asking about uncertainty, what to do with your money, if you want us to talk you into being in our funds, well, I wouldn't, because I invest in equity because there's uncertainty. If you don't want uncertainty, well, I wouldn't recommend our funds. We have real assets that are very well investigated, very well appraised. Can we go back to the latest, to the very last slide? Can I do that from here? Can we go back to slide 62? That's commodities in the stock market. And when you see peaks, it means the stock is cheap and commodities are high. And when the line drops, it's the opposite. And notice that since 1917, there have been 3 moments when commodities have been cheap in history. In the 29th, before the Big Depression, and despite the Big Depression, which goes as far as it goes in terms of uncertainty. And they did significantly better than stock because they came from a very low position of underestimation. The second valley was during the 70s, which was a time of deflation instead of inflation like 29. And commodities did significantly better than the stock market. And the third period was in the late 90s. And I would say the fourth period is now. So in a period of 100 years, 102 years, we've come to the fourth time when it seems sensible to invest in commodities. Statistically, well, we have to illustrate the case probability that the specific circumstances today make it actually favorable to invest in these assets or not. So what I have to say to this person, well, if you want liquidity as an element of protection, I wouldn't be so sure about that.
Yes, there are uncertainties. There's always been uncertainties in the economy, but we feel very comfortable on the long term with our portfolio because as the falls indicate and the valuations which we're buying, they already factor in the pessimism. Our companies are already discounting that things are not going to go that well compared to stock exchanges which are reaching maximum levels. So that's what we try to do. We always try to calculate the worst scenario. Nothing that, is unimaginable. But, for example, what happens if there's a recession? What happens if demand doesn't go well for a few years or if there is a recession? And that's why, apart from companies or sectors that already factor in the pessimism, we always add other filters. We always invest in low-cost producers that will always be there and that cannot be taken out of the market because they are on the low part of the curve. They're already low-cost producers. They have sound balance sheets. For us, the worst scenario, obviously, if there were a recession, the valuations that we calculate in our companies would take longer to get there. But we don't see a problem with having a permanent loss of value in any of them, or practically any of them. So the risk that we have is the annual rate of return, instead of being good, might be a little bit worse. But we're already discounting a pessimistic scenario, and if it doesn't happen, so much the better. And what you said, our investment vis-a-vis cash or fixed income, there's an interesting question here. The comparison between our investment and real estate investments. Is it better to invest in real estate and forget about it for 20 years or do the same thing in our funds? What do you think is a better opportunity right now? And it also adds in real estate, could be financed with very low interest rates right now. Buying property right now compared to our fund, I think our funds are cheaper. But also, I have to add that if you buy the property with a long-term mortgage at a fixed rate, the asset is the mortgage, because in this environment where there probably will be inflation, you don't pay, the debt is the same, and the property generates some income that will go up. It's today is it's very specific circumstances. It's attractive because you can finance property now at very low rates. But I think our fund is very attractive. Yes, the real estate, the return is 3.5–4% in real estate. We always consider the real estate asset. If we go for properties in important world capitals and the best neighborhoods, the yields there are low, 3–4%, sometimes 2%, and that's a free risk asset. For us, public debt has never been a risk-free asset because you have the risk of losing purchasing power because of inflation, particularly now when many of the countries have negative rates on their bonds. So real estate assets are risk-free assets. Usually you're protected from inflation because with a lag, but it does include the inflationary element, but it doesn't give you a net wealth accumulation that is, very different from other investments. And talking about risks, lots of people are talking about the statements of Moldwin or Mr. Buffett. And they say many of them talk about potential recessions. If that happened, how would it affect a portfolio so much exposed to commodities? It's difficult to say, but being very frank, we have to know if it's a global recession or if it's a recession in the developed world, which would also affect the rest of the world. But if it were a global recession, in effect, it would have a certain impact on commodities, but I insist, much less impact than the normal indexes in the stock exchange. For example, the recession of 29. The important thing, and we showed you the graph earlier, in 29, commodities performed much better. So the important thing is not so much to guess what is going to happen, which is impossible, although it's interesting to work on scenarios. But what is more important is knowing that 80% of the answer to the necessary questions is in the starting point. In other words, if we start from a point where commodities are in one of the 4 moments vis-a-vis the stock exchange that have generated extraordinary returns, I would dare say that it doesn't really matter what happens, because let's say there's a crisis. In 29, with deflation and commodities did significantly better. The reason is that commodities have something which is anti-recession. No, they go along with the economic or business cycle. But if the starting point is so low, that's what it's better to invest in. Perhaps Fernando can add something else to that. Well, not really. Let me repeat what I said 2 questions ago. I think that many of our companies, some of them already discount recession. They discount significant pessimism in demand, even taking today's price of the commodity. Sometimes we're buying companies that are listed at 6 times earnings. Now, what the market says is that crude oil will fall. The normal thing is to discount weak demand. So our portfolio on the short term, the stock exchange is more about emotions, feelings, sensations. And I don't want to say that if there were a recession on the short term, it might affect the portfolio and the settlement value would suffer. But the prices at which we are buying include these pessimistic scenarios. And I would add something else. Fernando gave me this idea when I heard him. Let's imagine that there is a recession. Okay, let's stand in the shoes of a politician. What would a politician do if there is a recession? They never stay put. They never do it right when they take a step, but they try to do something, with good intentions, of course. So a politician in a recession right now, he doesn't have, much ammunition. You can lower rates, or they used to help banks buy impaired assets, or stressed assets, but they don't have any more ammunition. Germany is in a recession. Italy in a recession. On France, you have the problems, the yellow vest making trouble on the weekends. But so they don't say the recession is going to start now, get ready for them. No, you notice that there's a recession a year after. So if we factor in the complexity of all these things that we mentioned earlier, as soon as the problems come, and they already exist in some places, and we also have Brexit, Trump, the temptation of the government, because he doesn't have many bullets to shoot, is spend money, increase public spending. And where can they get it? From their citizens, charging more taxes. And I think they've come to the limit, the tax rate, almost 50% in most developed countries, although there are differences between countries, or get a loan. But the debt figures vis-a-vis GDP is more than 100% in most countries. And number three is what all governments have always done, which is, let me play a trick, which is to print more money. They used to do it using less metal when they coined their coins. And in the weight and amount, that is where the trick was. Now they've created a system that has some advantages, but advantages for the citizen, but it has a huge advantage for the ruler because the Treasury can issue a bond. And that's what they call monetizing the deficit. Now, in a recession scenario, politicians are going to do that, then the contrary, then say, no, listen, we've got it wrong, so we're going to lower public spending. We're going to liberalize the economy. We're going to make tough adjustments for the population. That, in a way, was done in Europe, but he only has those two alternatives. So if a great recession comes along, let's calculate the probability of each alternative, and we do it with the probability of class out of 100 times that the government has needed money in history. 95% of the cases, they printed money. So print not the recent printing for the buying of assets, but spending money that you issue from nowhere. This is why the canary in the mine would be public deficit. And in the past 200 years, they've been printing because it's the most convenient thing. Before, they used to go to war to take it from others. But warfare isn't that easy today, and nobody's going to win votes going to war. So the probability tells us that they're going to print. And then we have to analyze country by country. Some countries will be more careful, have a culture of being more careful with the deficit. It has to do with the traumatic experiences generated by inflation. The Germans will have more than the French, although they had a few themselves, and more than the Americans. So if a recession comes, and at the same time, and this is already happening, there is an increase in the deficit, I don't feel protected neither with liquidity or bonds. Perhaps a bit when real estate, because if prices go up, the income from it will go up too. But and protected with shares. Shares have gone up a lot. So I feel protected in shares that have done well in inflationary periods and deflationary periods, because there is some wise men that know more about this than I do, and they always insist, you're playing everything at inflation. No, We're not playing anything at any macroeconomic scenario because the companies we would have because they are the most attractive in relative terms with what there is out there. But I insist in the deflation of 2029, commodities did best. Although, if there is a recession, orange. If not, blue. No, it's not that easy. Everything is in movement, and perhaps the measurement for recession will be adopted before the person knows that there is a recession. And when it is decided that public deficit instead of 3 is 4 or 5%, or inflation 3 or 4 instead of 2, that week the gold assets would go up 50, 60% in that same week. The returns, you know that always 80% of them are done 10% of the time. In 3 months in 2017, they went up a lot. Well, it's a long answer to the question, but this leads to that and that leads to this. It's not that easy. It's more complex than that because everything is interrelated. Sorry for that digression. Yeah, 14 or 15 questions I have here. So if you're going to take so long answering them, we're in trouble. Okay, question says, in case there's more inflation, isn't it better to invest more in the commodity than in the company? And that way we avoid regulatory risks. And if that were to happen, what other commodities apart from gold would be good to invest in? The final question is whether you want to buy gold or mining company or gold mining companies. Well, the companies, when the raw commodity goes up, they do better. Fernando, would you like to add something to that? We invest in equities and companies. Even the fact that they can adapt to situations of lower commodities, lower price commodities. In fact, in uranium, there is an exception because we have the commodity itself through a company, Uranium Participation Corporation and Yellowcake, which are vehicles. In these two companies, the potential isn't less than that of Cameco shares, because we think that uranium is going to go up quite a lot. And although you talked about this earlier, there is a specific question on whether we think that the ECB is going to increase rates in the next few years, and if Europe is with no ammunition to foster growth. What would happen if there were a recession at 0 rates? You already talked about it. We don't waste time knowing whether rates are going to go up. Not because it's not interesting, but because we don't know how to do it. Fernando, would you like to add anything? We have no idea if rates are going to go up or not. We don't care, really. There's one from banking. If banking shares can go up, well, I guess that if they make money, or that will they continue to do bad on the stock exchange? Well, you all know that the banking industry for us is very complex. And that metaphor that I used as the economy that is a set of short and long-term promises, the banking industry is a web of long and short-term promises that are with a lot of leverage, 20 times more assets than equity. And usually they are managed by people where there's nothing at stake for them. So it's an incredible cocktail, a business which is complex in itself too. So historically, most of them have had suspension of payments. And then, as one of our masters would say in banking theory, Aristoludo de Juan, he would say that there are more banks than good bankers. Fernando, anything? Do you want to add to that? They're not in our portfolios. And that clearly indicates that we're not convinced. Banks outside of Spain, we don't even take into account because it's very difficult to analyze a bank. It's almost like a black box. And in Spanish banks, we've been shareholders sometimes in the past, basically of Bankinter and Bankia, but not right now because at those prices, we don't think they're that attractive. Although Bankia is at levels right now that are a bit lower, the thing is that they're weak. They're weak. And they face a future with a weak capital situation and facing headwinds. So the combination of all those things, we think there are better things.
Venga, pues nos metemos ya con las materias primas. Hay muchísimas.
Okay, so going into commodities, we have plenty of questions. With a position of 70%, according to your data, aren't we taking too high a concentration risk? And that concentration, is it because commodities are so good, or is it because there are few opportunities in other industries? That's a very good question. Our ideal portfolio would be 50 companies, 2% in each, with a mathematical expectation of beating the index by 10 points in each, ideally non-correlated amongst them. That's the ideal world portfolio. But things do not happen like that in real life. So what we do is work all the time to try and find a few very good ideas, so that when we find those ideas, they have enough weight to compensate for all the midnight oil we have burnt. So obviously, we don't have a conventional portfolio. But the fact that it's not conventional does not mean it's not conservative. That's a more complicated question. I believe that the idea that the Earth was flat was a convention at some point. So we believe our portfolio is not conventional, but it is, however, conservative. That's my subjective opinion. That's why we have all our eggs in this portfolio. And it's a subjective opinion, of course, as all opinions are. But I believe there's a couple of objective tests to see if our portfolio is conservative or not. One is its behavior versus its index, and the other one is its behavior during bad market moments. And during bad market moments, our portfolio has suffered, but not as much as the rest of the market. So yes, I do believe that we have a highly concentrated portfolio because we like each and every single idea in there, not because there's a lack of opportunities out there. I believe that Caneco, Concert, and other companies in our portfolio are worth much more than the market realizes right now. Well, ultimately, we're always looking for challenges in our portfolio, and there are several ideas we study and analyze. But to go with another company or to bring in another company into our portfolio, we have to like it better than the ones we already have. And our collection of companies is hard to beat because of the extraordinary places and the extraordinary mines where some of these companies are located are just an excellent opportunity. It's not that we can't see the risk involved, it's just that we're excited about the opportunity of investing in some of the best deposits around the world at the right time in the cycle. We believe this is an opportunity we need to seize because it does not happen often. So we're deeply convinced about our portfolio, and well, obviously, yes, we have mostly commodities, but we still have some diversification, and not all commodities are created alike, nor will they move up or down in unison. So we do have some diversification. Some listener makes a direct connection between our investment on commodities and our vision on China. This person says that if we have so many commodities, we must have a positive outlook on China. And if there were a dramatic change in the direction of China and there's a drop in demand, how would that affect us? Well, I believe there is a certain correlation between some commodities and China's development. Obviously, China is an important player in the use of uranium because they're building so many nuclear centrals, but there is also India and Japan who are bringing their reactors back online. China is a big consumer of copper. Nearly 50% of the world production of copper is taken up by China. But India is becoming a very relevant player, and they continue growing. In crude oil terms, China is interesting. But once you have sales of 30 million in cars and a population like China, it's difficult to see a consumption of oil crumbling down in that country, isn't it? Well, of course, it suffers during a crisis, but not that much. And I believe it's much more about supply in China. It's not OPEC, it's not American Shell, where 45 million barrels go to a rate of 67%, and 500 million less investment is being made than in the past few years. And it doesn't look so clear in China. As for coal, well, coal in the United States has a higher specific efficiency. And, well, in the export market, China has some influence, but I do not see it as a kind of influence that could tip the balance. This person is asking about a possible recession in China. I invite you to watch Charlie Manger's annual conference in the Daily Journal Registered Company. He asks this question himself, and he said, if China has a recession, brace yourselves, because in Standard & Poor's, they might not be as protected as they think they are. Does this make sense at all? Of course it does. And you already said it. China is an important consumer for several of our commodities, not all of them, but definitely several of them. And obviously, if they have a recession, we would have some temporary impact. Obviously, they're growing at a different pace, but it would affect us, but not that much. And actually, it happened already in 2015. The use of commodities in China was greatly decelerated, and many of their commodities consumption dropped until early 2016. But there's one thing that we find very reassuring. We have no doubt that at a 10-year term, China will be consuming a lot more copper than it is consuming today, or at least just as much. And they will continue to grow at a logical pace of 2 to 3% below economy. And we can see that clearly. We've talked about the degree of urbanization in China, the industrialization they still have to tackle. In the next 5 years plan in the government, more investment is expected to be made in power networks and distribution networks. The penetration of infrastructures like railroads per capita is still at the same level as in emerging countries, so there's plenty of work there. And this is something we have discussed amongst ourselves. The stocks of many of those commodities per capita in China are still a fraction of what they are in the West. And yes, China is on the path of becoming a world power. They're big savers, big workers, or hard workers. And of course, the fact that they can have a bad year is no big concern in the mid-run. So, Fernando, let's go back to gold. Somebody wants to hear your opinion on the latest corporate movements in gold mines where several mergers and concentrations have occurred. And considering the traditional lack of discipline of management teams in terms of capital allocation, etc., what's your opinion on the matter? And this person feels that the gold industry remains low premium in transactions, and they're still 2/3 below those old maximum levels. So this person is trying to probe how you feel about these latest transactions. Well, that's 3 or 4 different questions wrapped into one. So let's start with the last one. There is a feeling of gold being or going through a low. Well, that's precisely why we're investing in it, because it's going through a low. If it were going through a high, we'd be selling right now. Gold has always been the accepted currency for psychological reasons because it's no one's debt. All of you sitting here owning assets, think about which asset, what do you have as an asset that is not someone else's debt? You have gold, and there's no further link behind it. And for that psychological reason, gold has been equated with money historically. But there's another historical reason. States have failed, and this is a fact. This is a known fact. So it comes and goes, and as trust in currencies is reduced, gold will increase its value. As long as countries do their duty and their homework, their currencies will be trustworthy. But if not, gold will always be there. Hugo Mining would be worth 40% more. Buenaventura, with all the copper they have, would be worth twice as much. So in those circumstances, we need to study the probability that governments will do their homework or not. Gold is an investment that precisely for going through a low and a low feeling, if, I don't know, it's a toss of the coin in the next 4 to 5 years. But that's for gold in general, although I'm just repeating what Fernando said during his presentation. And then as for these mergers we've seen, well, when an industry is subject to so much stress, like, for instance, the fact of their price going from 1,900 to 1,200, in an environment where much investment had been done with heavy threatening debt, the consequence is that assets go to the hands of those who didn't perish along the way, the ones who are either more conservative or better managers. So yes, these mergers mean that assets are going into the best hands. Randgold, which is actually one of the most profitable companies in the index, so you can always make money with a gold company. Well, Fark Bristol actually acquired Barrick, and now Newmont, one of the best managed companies, want to acquire Goldcorp, and Mark Bistor wants to buy Newmont too. It's almost like musical chairs. But in general terms, yes, that is what happens. Assets tend to trickle into the best hands, and I believe that's extraordinarily good news. I don't know what you think about it, Fernando. Another question about gold. Investing in gold has a lot to do with macroeconomy and its possible scenarios. Do you intend to keep this position structurally or just temporarily? Well, we've never had any stocks structurally considered. We play with value and price. If at some point price reflects value, we move on, right, Fernando? We've never had a structural position. No, we haven't. Our aim is to buy cheap and sell high. More questions about new gold. Someone says, isn't now a better opportunity to invest with a change in the management than when we invested in it? And yet we haven't accumulated much during the falls. Well, we acquired another one, but it's difficult to see. It's dropped so much that a 0.22 or 0.28 is not, it's almost negligible. It is true, however, that right now is even a better opportunity. New Gold is one of the companies that saw one of its best mines not going very well, and they went down by nearly 10%. But right now they have a new CEO. We like this person very much, and much of the risk has been pruned away. And the financial situation of this company, can we face our financial duties? Any capital increases? We do not believe a capital increase will be required. Considering the New Afton cases and the Lemme River circumstance, if a capital increase were required, it would be tiny. So unless a lot of people are very interested, we should move on. Okay, let's move on to crude oil then. Can we explain the thesis of oil supply? Oil supply, yes. Somebody wants to understand this. Well, as we said, we believe that there's a lot of pessimism in the crude oil industry. with examples of companies that are low-cost products that were buying at 6 times earnings, and those are bringing in a lot of pessimism. And right now, in the Standard & Poor's 500, the energy industry is going through historical lows, and the long-term curve of crude oil is assuming it didn't even budge when the crude went up, and they're assuming that the price will go down to $52 per barrel. So crude oil is showing pessimism on the side of demand and some optimism on the supply side. On the side of demand, I don't know, a little bit recession and maybe going narratives about the peak demand, considering power cars. And in that sense, there's a lot of pessimism. We take it for granted that demand will grow, not spectacularly, say 1%, 1 million barrels per day. That's not even as much as it's growing today. And having deeply studied the power car implications and trying to be optimistic with the adoption pace of electric cars, we still have detected no important drop in demand. Well, per capita demand in the Western world, maybe, but not global demand. So we believe that the hypothesis of increased demand of 1% seems quite sensible and even conservative. And on the supply side, well, the market in general, as considering the new Saudi Arabia, which is these shale oils in the U.S., which are growing at a spectacular pace and which apparently will be fulfilling any needs for crude oil in the market. Well, we've done our homework on this front, and although we consider that this area will continue to grow for the next 10 years, they have spent a decade trying to get over their learning curve. It seems like the best producers are making money now, always with the support and financing of the market and even high-yield debt. But we feel that ultimately there's a limit to that. If we consider a growth in demand of 1 million barrels and the rest of production, which has been going through one of the worst crises ever in the history of oil, it feels like we're seeing a decline very soon on everything that is not shale in the U.S. Even in a very stable part of the market, let's assume that OPEC and Russia, which are nearly 50 million barrels together, continue producing at the same pace. There's a whole other area, 36 million barrels off U.S., in which investment have fallen dramatically. And offshore investment has dropped 85% in the past 4 years. So that's when the decline is going to come, and we're talking about nearly 1 million barrels per day. So growth in demand plus the 2.5 million decline is about 3.5 million decline in a day, which doesn't allow us to think that shale in the U.S. will absorb all that drop. We expect some deficit in the crude oil market in the next few years. And speaking of offshore crudes, some people are asking how come the day rates of offshore platforms are not going up, considering that they're going back into production, as you just said. Well, precisely. We were saying that offshore is practically 30 million barrels a day, and the industry has suffered a collapse due to the strong growth of shale possibilities in the U.S. And I believe that the maximum was 2013, 170 billion invested in offshore platforms, whereas the minimum was 20-some million dollars. That's a big drop of over 2/3. And it hasn't been too noticeable yet because these have long lead times, but eventually it'll be noticed. There's a little bit of overcapacity in oil platforms. Demand has not recovered strongly enough to cause a price recovery, but it's a matter of time that there will be an important decline in that area, or that investment will return, and in this case, prices will recover very quickly. One example in that recovered niche, it's the harsh environment area. Areas with tougher conditions, the North Sea, where more specific platforms are required. Well, right there, in only 4 quarters, when usage went up from 65%, daily fleeting went from $150,000 a day to 330 less than a week later. So they more than doubled, precisely because usage rate went up from 60 some to over 80. So it's a very sensitive industry. As soon as usage enhances or grows, it is noticed. And maybe there is a nuance to add here. I believe this person is asking why activity is not going up. And that question somehow shows a certain lack of patience. In the short run, much of the market is about psychology. In the long run, it's more of a balance where things fall into place. And the difference between the short and the long run is made by facts, hypothesis, and reasoning. If it is true that 40 million barrels a day will decline depending on the area, if it is correct that shales cannot grow much faster than 2 million barrels a day, and if it is correct that the world continues to grow and the demand for oil has been overestimated for 7 years in a row, then that's all the math you need to do. It's not comforting when you see it's not going up immediately, particularly with shales. But I was talking to someone and I was telling them about the copper crisis in 15. And this person said, well, this is all fine and well, but the shares are not going up. And with a lot of patience, I would say if someone is concerned that their stock is not going up, I would tell them that they need to be patient. If it's in our fund, rest assured that it will deliver. And in the offshore area, the reasons for investing in Exco and Transoil. Well, Fernando, you're the one who knows them best. We do have a slide where you're in a picture with Ensco and with Diamond. I saw you there. Look at him. Diamond offshore on the lower left, and on the upper right with the Enscope CEO. And also I met with Victor Monagas in the Canary Islands. And we were talking about the large number of platforms that were just sitting there in that area that is not as harsh as others further north. Therefore, these big animals do not rust as quickly. So we invested in 3, Enscot, Association, and Diamond, for different reasons. And we picked these companies to invest in because they fulfill certain requirements. First of all, these are companies that own a good fleet of platforms, and they have upheld it during the crisis. They retire their older platforms. They've made some interesting transactions, both Transocean and Mexico, by buying during the low cycle, which is what you need to do. You need to invest in expensive assets when it's the right time to do so, because one of these things can be $900 million. So they invested during the low cycle, and now they have a modern and high-quality assets, a young fleet, which is important. And they're the management teams we like best. Plus, they have a very comfortable level of debt. None of them have any important amounts due by 2024, and perhaps they go all the way to 2030 or 40. They have very long-term debt, so they can comfortably wait it out until the market recovers. And they're very cheap. Transocean is perhaps not as cheap, but they're the largest in the world, and they're also the safest. And they also have the thickest contract portfolio, so they're generating a lot of cash flow, but they're all very similar, and we decided to invest in them because they had a few features that we liked better than those of others.
With regards to the judicial process of Petrofrac.
Petrofac, efectivamente.
Petrofrac, yes, the CEO, they're being investigated, have been for some years, for alleged kickbacks to get contracts to build refinery elements in the Middle East. Petrofac, 345 million shares, I think I'm remembering by part, listed at $2 billion. Kind of net cash of 700 is worth 1.3 billion and making 300. 4 times earnings. We think that the company is worth 11 per share, and they might be fined 500 million. It would be disproportionate given their size and given previous fines against the Rolls-Royce, Tesco, and others. So I think it's all discounted in the share price. Nevertheless, even so, maybe there might be something we're not seeing. And depending on how the case goes, it might lead to a deferred prosecution agreement where the management team would have to leave. And that in Petrofac, it's a people business, so it might have an impact. That is the reason why we're not buying in Petrofac, because there are risks that you need to acknowledge that you cannot control. Because the SFO has already fined 7 companies. So if we go from a very frequent debate where the historical observations is 1,000, it's very easy to predict. But in this case, it's more difficult to respond. So we think that a fine is already discounted in the price. But we have to be prudent because we don't know what else could happen. So that's why we're not buying more. I'll let you rest a bit, and let me ask a couple of questions for Sergio. Sergio, what amount has been allocated for the cost of analysis? Well, in 2018, this comes from one of the requirements of MiFID II, one of the regulations that I mentioned in my presentation. In 2018, Azvalor funds did not break down the brokerage and analysis service cost. That cost has already been differentiated since January 2019, and the impact that we are estimating of the cost of the analysis service and the funds is 3.5 basis points. In other words, not even 0.04% of the assets. But the conclusion would be that one of the aims of the regulator, or the main objective of the regulator, was to go from implicit to explicit costs. There was a service that was paid when we paid for the intermediation cost before MiFID, which is the analysis service, the research service offered by brokers. And what the regulator said was that that service has to be billed separately. So we need to bill for the brokerage cost when the deal is done, made, and separately the cost of analysis. The pre-MiFID situation, or post-MiFID, if we compare it to what happened before the change in the regulation, is that the intermediation cost and the Azvalor funds is going to fall by 35%. So we're going to have a savings of 35% of the intermediation cost compared to the pre-MiFID situation, which was one of the aims of the regulator to improve the efficiency of those two services, and they are going to achieve it. In regards to Azvalor manager, what type of managers per type of investment that can you include to complete the current portfolio? Well, for managers, as I said earlier, the idea of the fund is never going to have 15 or 17 managers. We want just a few managers with very few companies in their portfolio so that we don't have excessive diversification. Now, having said that, if we find a manager that complements very well what we already have or improves what we already have, we would include them. And there's an area which seems only logical to look at in detail, and that is Asia, where we do have a certain exposure because of some of our managers. We don't have a specialist as such. And if we have someone that meets all those requirements, we would ask him to join. But if we don't find anybody of top quality, then we wouldn't. We want to invest in companies at an individual level, and those companies, we want very good people to pick them. So if we can find that, they would be included in the fund. Is there a manager that doesn't want to work with us that you have pre-picked and they didn't want to work in the fund? Well, curiously, one of the 4 that are in the portfolio initially said no. There is one specifically, we got in touch with him and he said, thank you very much for your interest, but we're not interested in working in a structure such as yours. Our answer was, let me explain to you who we are and what we want to do. And the first contact with them, more than us analyzing them, they analyzed us to see whether they wanted our money, see if we wanted us to be their customers. And I did my homework really well. They took quarterly letters of Azvalor and Fernando. They looked at our website, so they did their homework too. They saw who we were, and with frequent conversations with them of understanding the way we do things, I think they got to respect us, and at the end they did give us entry. And having seen that the current managers represent a lot in the American market, if you're thinking about Asia, you would need managers that operate in Asia, China, in India, etc. Well, in such a heterogeneous area of the world like Asia, you need to strike a balance between somebody who is either very good locally and knows a specific country, or somebody that has a more general view and can bring his ideas. The first part would be a smaller universe with a very good manager. The second one would be also a very good manager, but more generalist. So I can't really answer your question because we are right now looking for that manager, and as soon as we find the right balance, we would see whether it makes sense to go for someone who operates in one single country or somebody who is more diversified geographically speaking. Thank you, Javier. Back to the table. I have a question, a very provocative one. Funds have a lot of liquidity until December 2018. Is that a signal of fear or insecurity? I don't understand the question. Excess liquidity that we have in our portfolios, I'm reading it literally. Is it a signal of fear or insecurity on your part? We don't have that liquidity. If we did have liquidity, it would be a signal that we don't find opportunities and that we don't want to invest with a gun pointed to our head. Liquidity in our case is a result of not finding companies that, either, the right companies to invest in. Going back to commodities, taking into account the new regulations on climatic change, isn't it too risky to invest in sectors related to fossil fuels? Well, let's say what Fernando thinks, but I would say that the risk, it depends on the entry price. And then the new regulation on climatic change is not a clear regulation. It's not really binding, only in some places, and it hides a reality. There are fossil fuels that, yes, they might pollute, but there are younger poorer countries than others. Japan, Europe, Australia, Canada, and the USA. Think of a patient in a hospital in India. What he needs. In those countries, well, the situation is different. In fact, there is a book I read from a game specialist who said that climatic change has a lot of power because it's politically correct, but the web of commitments here and there in a few years will be diluted. Now, there are people who no longer invest on these things, so that takes away buying pressure. There might be lots of people who, looking at the prices, can't resist it, but their analysis firm, management firm, does not allow them to buy that. Our comfort comes from the fact that we're buying at 4 times earnings. So since every year they don't throw away the money, in the fourth or fifth year we've recovered all the investment and we have the principal for free. So good things happen when you buy so cheap. Fernando? I fully agree. It's what we're seeing. It's the entry price. A good example is coal in the U.S. I share the opinion, and I have no doubt that coal will end up disappearing. But today it is still 30% of the energy mix in the U.S. So you cannot do away with coal, neither tomorrow nor the day after tomorrow, nor for a long time. And in the case of, and we're buying 4 times earnings. So Colson, even if the price didn't change, we would recover our investment and would have a good, very good annual rate of return. In the entry price in a commodity that is still very necessary, I mean, it's a no-brainer in terms of regulations that have to do with climatic change, which, by the way, as you said, the stability of it, you can even, perhaps have your doubts. If you remember, for a long time, it looked as if gasoline cars were the enemy, and we tried to switch to diesel, and now diesel is the one that pollutes the air the most, the air that we breathe in cities. And we're going back to petrol, although the future, of course, is the electric car. But in these emerging countries, many of these things are a luxury. They don't have access to electricity in some places. And oil is incredibly efficient in the combustion engine. It's a miracle moving those vehicles of a tonnage for the cost of that. You can do it with petrol. And most of the value in crude oil that we put into our gas tank is taxes. The government take the part that the government keeps between royalties, special taxes, etc., is about 80% of the value of crude oil. Then, of course, you need to ship it, refine it, pay taxes again, and at the end take it to the gas station, where once again most of them are special taxes again. So if we really looked at the intrinsic efficiency in the combustion engine in countries where there are thousands or tens of thousands of people who can afford a car for the first time in their lives, well, it's very clear for them. The electric car, of course, in California and other places, it's already happening, but in other places of the world, it's still science fiction. So from petrol, let's go to maritime transport. If the investment thesis of maritime transport is linked to the price of oil, why do we have a very small position in shipping compared to oil? And the second question is, why did you sell Ticket Antes? When did you sell and change for international seaways? In the shipping industry we like, there are some elements that make it less attractive than oil, but Fernando is the expert on shipping. And ticking tankers, we reduced our position because we found another one that we found was cheaper. In shipping, the tankers that transport crude oil, they're one that is more dedicated to transport of chemical products. But it's related to crude on the side of demand, but it has more to do with supply, really. As usually happens, demand in this industry is very stable, growing with world production. It oscillates, but very small oscillations. What really changes from one cycle to the other is the amount of tankers in the sea. And what's happened in the past few years is that there were too many tankers. And this is a commodity sector in terms of fixed costs. It only has fixed cost overheads. So the ship owners turn into price takers. They take whatever price there is, and sometimes almost generating losses. And in the cyclical sectors, it always happens that what is good for a bearish cycle are prices. Prices were so low that it wasn't worthwhile, paying money or spending money to get them checked to continue to have an operating license. There was a lot of scrapping in tankers. For the past 15 years, it was the highest number of tankers that were scrapped. And demand goes at that same pace with some oscillations, depending on what the OPEC decides to do every 6 months, but growing more or less with the growth of oil production. And these tankers are being listed at spectacular multiples, 2 or 3 times the normalized earnings. And I say normalized at average earnings. Or if we compare it on the side of assets, we're buying companies that if we calculate the value of the tankers, which is a very liquid market, and you can know what it is very easily, the price at which we're buying these shares is about, with a discount of 30 or 40%, taking into account the debt of the tankers. Otherwise, the discount would be of almost 70%, so really very cheap. Gas. Why did we sell CNX Resources? Why did we sell? Because we found better things. All right. There are several questions on technology. There's a world beyond commodities. Why don't you ever invest in technological companies? Well, Facebook, Alphabet. What is our view on technology? Well, we're not agnostic to any business, but we're relatively limited, and there are things we don't understand in technology. Thanks to someone who's sitting over there called Rafa, I've learned a great deal. And Google, we saw, could be understood and we could buy into it. Facebook, that was more difficult. But I insist, because when I said we don't understand it, of course we understand what Facebook does. But it's very difficult for us to foresee how much money Facebook is going to make in 5 years, and particularly from year 5 to year 25. People know that, but we're not experts on that. For us, it's hard to tell. Perhaps Javier can find for a fund of managers, who knows about these things. It would be very interesting because it would complement what we already have. Because, of course, the technology will be there, will continue to be there, and a lot of value can be created with it. Fernandez, do you have anything else to add to that? No, we're not agnostic, but such a large company followed by millions of analysts, and that only goes up and up, and that so many people talk about and write about, around which there is so much thinking and scrutiny. It doesn't really call my attention that much, really. We said the same thing about Amazon. Yes, I'm sure we will miss out on things, but if we have to punish ourselves for everything that goes up that we didn't buy into, what about cars? How can operational margins of companies vary in car manufacturers with a self-driven car? Isn't that a bit uncertain? And another question is, what is our exposure to vehicles, and do we think that most of these things are already included in the price? It's through Hyundai. That's our exposure. That buys through preferred shares and the liquidity that the company has in its current account, plus its financial company and a few other assets, are more than what the whole company is worth. So we have a company for free, which is in emerging markets that are very interesting. For example, India is number 2, and they're number 1. Marubi in India, it's number 2, and as to how would electric cars affect the margins, that's a complex question, because what is clear is that the industry is facing investment challenges. We don't know whether they will self-driven, hybrid cars, electric cars. We think Hyundai is the most interesting one, and the others, we think we have the best. What do you think, Fernando? Yes, we can't really tell what the future will look like for the motor industry, but we don't need to. I also confess that despite the fact that we spend a lot of time, we don't understand it that well. We bought Samsung Semiconductor shares, and when it went up 100%, it was 4 times earnings. We decided to sell because we didn't understand it that well. Marie Brizard comments. One of our investment mistakes. It was a company that tampered with their accounts, but it was our fault because we should have realized that something fishy was happening. The assumptions were good, the approach was good, but there was someone, the CEO, Renault, who altered things. And we could have seen it maybe. It's very difficult to learn something from Marie Brizard. Only that when you say something and do something different, you have to be careful. But the important thing about the mistake is how much you lose, and that should be offset with what you make when you get it right. Marie Brizard was a significant position, but it wasn't. It was 2%. So it is a company that took away 1.4% return. But with what we can see for the next 4 or 5 years, it's a company that we thought was going to make 60 million in EBITDA, and it's going to be very difficult for it to make 10. And when that happens, you make a mistake. And our investments in the future will see temporary variations that will be very big. Sometimes a big mistake like that of Marie Brizard, and we have to accept it, and this has been one of our mistakes. We're asked who are the best and the worst management teams of mining companies in mining companies. Well, that's very subjective. Consol's team is very good. Atlico's team is very good. Bonaventura team is very good. Fernando. And Rango. Yes, absolutely. I agree. And Cameco too, they've made a few mistakes, but the way they faced the crisis, the decisions they made that were not at all easy for them. Also, their dealings with the Canadian government, being very firm in their position and being very skillful with one of their main clients, their relationship with utilities. They did things really well when it was not at all easy, and they had to close the mine. I think in general, I would say we have very good management teams. And why did we sell Samsung just now? When Samsung is starting to improve, they're buying back shares, they're increasing their dividends, because we have better things to buy. And in general, what happens if the market does not recognize the intrinsic value of the international portfolio in a reasonable period of time? You have 6%, very far from historical 16%. What can you expect for the future? Well, it's actually three questions. In terms of whether we have to lower our expectations, yes, we've seen that an American bond gives you 0%. So absolute expectations don't look really good in any class of asset class. And I think we explained that in the first slide. We see slide 3 or 4 again, please? We can take a look at the different asset classes because it's not us who have to say what the expectations should be. I think it's slide number 5. There it is. That's what it's looking like. Inflation 2%, 0% bonds, 2% S&P -2 in liquidity. So doesn't look very good, does it? Now, we think that commodities look very good because we have 9% actual yield apart from what we're able to add with our picking. We have to think how much we got out of the market then, how much we made in absolute terms, because you're going to measure us in 5 years vis-a-vis the market. That's how we measure ourselves. So historically, Beltran, correct me if I'm wrong, but 800 basis points? 800 basis points. Now we are less than 800 basis points, but we think we have a portfolio that is undervalued. We achieved it in the past, and well, whilst we continue to do so, we will get our management fee. And as soon as we don't do it right, then you will leave, and rightly so. 800, but not always 800. Sometimes it's been much more than 800 or much less than 800. Fees. Are you thinking of reducing management fees, taking into account the contraction of funds in passive management and in fund management in general? Yes, undoubtedly. It allows you to have access to those 300 basis points that we talked about compared to fixed income. Now, fees, if they're high or low, that depends on the return. Historically, 15, 16% a year, that's how much we've made. Nobody has complained about paying 1.8. The problem is when you pay 1.8 management fee and you get zero negative return, which is what happens very often. I think that whilst we generate the returns that we have achieved historically, we're not going to lower management fees because the competition does it. But we need to be humble and realistic, and if we don't get enough profitability, we need to not lower management fees, just go home.
And one last question, whether we compare ourselves to the utilities FD. Yes, well, there's usually always someone who does better than us with commodities. The problem is that we believe it does have a value to know when to be in commodities and when not to be. So no, I don't compare myself to them. Not at all. Do you, Fernando? No, we don't compare ourselves to anyone. We don't do that kind of benchmarking. We had our time where we had our exposure to commodities. Okay, so let's go to the Iberian portfolio. One of the pillars of Azvalor is investing in good management teams. And we know that those teams are actually invested in it basically because we invested in OHL. What did we fail to see? Well, that was a mistake we made in the quarterly letter that we wrote about a year and a half before. We were already warning that this mistake could be made, so we were silly enough to see the error coming and still mess things up. But it was not our error. Some people say that the Villarmer family were uh, were deceived. They did fail to give us information we thought must have been available to them. Obviously, when you do a tight calculation, nobody knows what the end result is going to be. The mistake in OHL is that when a construction company grows, they generate positive margins and positive cash flows. When the expected does not happen, and when the backlog does keeps shrinking, erratic decisions are made. Less cash flow is coming in, and to compensate for that lack of liquidity, they tender at a lower price, thus compromising their future margins. And this is something all companies do, not just OHL. Although we knew all this, when we went in after the sale of the concession subsidiaries, the company had 1.8% net cash flow, and their net worth was 1 billion. So clearly, we had a 1 billion cushion for them to lose money over legacy projects where there are problems. I'm sure you have done some home improvement works where one thing leads to another. And in the specific case of OHL, there had been so much rotation of people in construction and on the management that managing client demands and supplier demands with a highly rotating staff becomes very complicated. So yes, maybe we should have seen that despite the excess liquidity, the potential statistical losses in a set of contracts they went into under pressure uh, could have led to problems. Of course, we went in with over 3% of them in the fund, and we collected over 50 cents in dividend. And, we do not believe they're going to zero. Right now, they are 1.9% of our fund. And one thing the market does not see is that OHL have assets that are worth something, although they don't generate cash flow, which is a bit of a contradiction if something that's not generating money but still has value. And the thing is that OHL has transactions in America that are very interesting for the Chinese to set a foothold in America. So we believe that they still have some worthy assets. And considering what the Chinese could pay to get their foot in South America or even the U.S., where they have a local company, UCLA, plus real estate developments and the still existing cash flow, yield a value that for the time being makes it advisable not to sell. Perhaps at some point the net result will be negative, but not as negative as it seems today. And, well, there are always lessons to learn. One last question for the Iberian region, and then we can move on to something else. Melia, a strong percentage of the Iberian fund. This person says this company has huge losses, which is not very positive. Plus, if the company keeps selling hotels and moving on towards the lease model, you know that these are the causes for these losses. Can they still correct their direction? Well, this person seems to have asked several questions. Remember that the Malia Hotel, or the hotel business, has three legs: owning the hotel, paying a lease, and or managing the hotel, or just managing it and getting a percentage of the earnings. So the portfolio of Melia Hotels is worth 14 euros per share, and I believe their stock is 8.8, meaning that only with the hotels they own, we already have a very interesting potential of over 50%. Then they have a lease business. It's a score of hotels. So for some of them, contracts were made during the high cycle. Since they're all long term, they make it difficult to make money. So beyond paying the regular expenses, they will still have an extra item for the lease, and some of them are expensive. I do not believe they have a majority of those, as this client seems to believe, and out of the net lease or the net amount of lease and management, they're still generating cash. So those 14 euros per share still have something on top. So for Meliá to be worth 15 or 16, the numbers are correct. But when we go beyond the numbers into the people behind Meliá, we meet Gabriel Escarrer, the youngest child of the founder, and we believe this is an extraordinary person. This is a person with a magnificent tactic and strategic vision, a hard worker. He couldn't have any more skin in the game. And we must remember that Meliá and larger cash companies were the ones who invented world tourism. So a top company in tourism having a stock that is worth less than actually the brick and mortar they own is a very good option. Is this only for VIP customers? The answer is no. How much equity have you invested in all funds? All of it. That's the answer. I will let Fernando answer that one. Well, everything, we have invested there, everything except our homes, right? And our funds. Yes, including the manager's fund. And a small amount I haven't touched for a while since we funded Azvalor and we left Stimver. If somebody wants to come in with 100,000 euros, where would you advise them to invest and in what percentage? Well, I myself am a little bit confused because since the fund is so weird in liquidity right now, I believe that personally, I have 60% in international, 20 in Iberia, 15 in blue chips, and the rest in the manager's fund. That's my personal stake. How about you, Fernando? I'm not exactly sure about the percentages, but I believe mine are very similar to yours. Maybe a little bit more in blue chips and similar to Iberia, but yes, very similar. Well, the idea is weighing international. Iberia needs to be below international. Blue chips is a fund that we won't be recommending long term. The thing is, it's so small right now that it has the flexibility that no other fund has. So it's interesting to be there. And the manager's fund is something we like very much. So Fernando the manager's fund comes from the fact that Fernando and myself wanted to invest with other people in those verticals we couldn't reach, and we met the person in Spain who knows the most about this, which was Javier. And out of that merger of elements, the manager's fund was born. Do we apply environmental, social, and governance criteria? No, we focus only on legislation. In principle, we don't try to guess whether the origin of coal is good or bad. And we believe that in all those narratives, something lurks behind, which is the future class struggle, because the struggle of classes will not be about money. It'll be about who has something at stake and who hasn't. And last week, we saw the Queen's Congresswoman to decide on her own that the 25,000 jobs that man was offering would alter things. The ones that Amazon was offering to contribute, and then they went over to Pittsburgh. And the next day, this Congress lady went home and had some coffee over it. But the lives of the Hispanic and the Afro-Americans who had voted or showed up in the polls to prefer the alternative of Amazon being there, their lives were affected because Ms. Cortez wanted to add a like to her political correctness. So there's a boasting analyst that says that coal is socially responsible because when human lives, like keeping warm and being able to use an operating room, are more important than the fact that whether climate change is man-made or not, it's a difficult decision. Well, CSG funds should be in copper or even coal, and he explains it very clearly in a 100-page document. Well, I'm not knowledgeable enough to tell whether there's climate change or not, and I find it suspicious when I see an entire industry built on that discussion. Of course, I wouldn't venture saying there's no such thing as climate change, but, well, I'm really beating around the bush here. But on the question of social corporate responsibility, I believe we should at least determine the terms of what climate change is from the perspective of a surgeon in India, for instance. Well, obviously, we like companies that that have generating profit as their target, because after all, that's a very social endeavor. Ultimately, profit or earnings is a sign that a company is using scarce resources to give value back to society. And this has allowed us to breed and to prosper. So profits are very social, and we believe that profits should be the priority of companies. A more technical question. How long is your horizon when valuing companies? Well, technically, it has to be on an infinite horizon, because a company's priority gives you access to their cash flows ad infinitum. The thing is, nobody knows what the cash flow is going to be after a certain time. Some particularly smart people have succeeded in envisaging that Inditex would be growing at 5% a year and like for like. We failed to see it. Whoever saw it hit the sweet spot. But what we have done is analyze the robustness of the company in different environments. If we believe that the company is going to make 100 euros and that in the most stressed scenarios, considering the controllable values or variables, and they don't have a high dispersion range, we use those 100 euros to evaluate or to assess the company. And then 4 times a year, we update those numbers. But that's the problem. And that's why I like that question, because when you assess a company, it's ad infinitum. When you talk about 5 or 3 PER, that's only for that year. And what we do is we standardize those earnings and say, well, maybe now the profit, maybe Samsung's P&L is 5 times profit, but if the semiconductor cycle crashes, it might crumble. And that's a whole trick in valuations. Valuations are to perpetuity. And when we make comments about a company and when we read a narrative, we always should keep it in the back of our minds that this is a commitment for life. And yes, of course, the sum of short-term news actually makes long-term. But we try to see how solid the company is in its industry. Are the managers smart? Who can hurt this company? Can the regulator attack this company for some reason? And if we find the answers to those questions, we can have a reasonable forecast for, say, a 5-year future in a company. I've never gotten much further than that. Have you? Well, maybe in highway infrastructure, perhaps. Regardless the price of shares or the evaluation of assessments, how are the businesses of our companies doing, and which of them are doing better and which are worse? Well, that's one long question to answer because we have 50 companies in our portfolio. I believe Fernando clearly explained that uranium is doing very well, and that's 10% of our portfolio, and they depend on the price of uranium going up. Last year, it went from 20 to 30. At 20, everybody loses money except some people in Kazakhstan, so it can only go up. In that sense, uranium companies are doing well. Nuclear centrals are reopening in Japan. India and China are clamoring for new reactors. Well, last year they went up by 20. This year they'll go up by 25. Apparently, until they reach 30, no long-term contracts can be signed. So it feels like they're doing well. Our oil business, as Fernando explained, offshore drillers are not doing well. But obviously, that's when you need to buy in because these are long-term companies, which is the same situation as with gold. With coal, we're lucky enough that it's doing well and it's still cheap. And probably because very few people want to go into coal. And then the situation we have in other commodities are very specific. But in general, our businesses always have this small dark cloud that makes other people nervous. And that's precisely why we buy them. But fund trends in general feel very reassuring to me. I'm reasonably convinced that at the present prices, much of the bad expectations are already discounted and there are good things ahead for us. Do you think the same, Fernando? Yes, and also in terms of controllable variables, because many companies are in sectors or industries where there are or variables out of control. Within controllable variables, every company is doing well. Some of them come from a crisis situation, and they're making the best of those difficulties to improve internally, to lower costs, at a time when it's worth investing, when the industry is depressed. And all of our companies are doing well in that sense. And one question about Asia. We're not investing much in Asia. Is that because of macroeconomy? Is that for other reason? Well, that's another good question right there. It's a little bit distant. That would be my first answer. We like to know company products, and of course, you can do you can study the products no matter where you are, but we like to understand why the board members are who they are, how invested they are, whether or not they like to be in the company, what families they come from, and how people feel about them, the Makuta ratio. So you can buy a company in Asia, a global company like Hyundai, selling cars all over the world, but investing in Asia in general terms, it feels like you're more likely to get cheated. Well, I heard you don't have a WhatsApp account. Why? Well, Fernando does have a WhatsApp account because he's a serious professional. I do not have a personal WhatsApp account. I don't. And it's not because I need to concentrate a lot more. I don't know how this can be interesting for anyone, but I'm answering anyway. My wife uses WhatsApp, and it's not like she is texting all day, but it takes her at least 40 minutes a day to catch up with WhatsApp, and I don't have that time to spare. I want to devote that time to my children or to reading. So 40 minutes a day times 7 days, well, if you start doing the math, it's mind-boggling. I just don't have time for WhatsApp. So I don't concentrate as much as you do. Well, I'm in greater risk. I do have a WhatsApp personal account, and analyzing its use retrospectively, it helps me communicate better with my family, faster than the phone. 3 last questions, 3 requirements you consider when you cherry-pick your team members. 3 features you highly value when you pick members for your team. That's a good question to talk about our team in general, because I believe you need to have as much information as you can about your successors, etc. Right now, there are 3 people in management, Michael Ezelem, Fernando, and myself, the 3 partners to the company. And hopefully, we will remain there for a while. Then we have our team of analysts. One of them just became a notary public. He is Victor Monagas. He is the head of analysts. And what did he have that was so special? Well, first of all, he has been a compulsive reader since a very early age. Second, he kills at company analysis and modeling, and he knows how to summarize. Beyond that, he is an expert in the Austrian school. That, coupled to an unbelievable capacity for hard work, makes him an ideal candidate to follow up on the whole portfolio. So it's not an exaggeration when I say that Victor is our fourth manager, even if it's not one officially. And then there are 6 analysts reporting to Victor, and all of them have interesting features, each in their own industry or field. Some people have the ability to guess future trends and think critically. Others are meticulous at their work. We have young people that are bursting with energy, and all of them have something special about them, something interesting, and they all work very hard. As a matter of fact, at the end of the conference, we're inviting our analysts here on the podium because they're such hard workers. And, well, they all contribute until they reach the level when I give an idea to Fernando or Michael gives me an idea. It's not that we're smarter than they are. I believe that many of them are smarter than we are. Criteria to find people, well, getting to know them. Sometimes when someone leaves, we know that what they do is very important. But finding an agent is just something that happens to you. There is a lot of serendipity involved. So when we come to that finding, we will recruit them. And perhaps we would like to have an extra manager. As you will see in oncoming years, if you stay with us, you will realize that Michael sees things we don't see, and we see things our other managers don't see. And that's what makes us so efficient. Remember that you cannot just go out there with a wish list. There has to be this ideal person who has done a little bit of all the different levels and industries with who has followed the Austrian school and who is not a follower. I don't know, someone who can convince us that Facebook is worth 6,000, and this is not something you put on a wish list. And these good people, and I'm sure that there are some among the audience who want to have their own fun. So it's very difficult to find the right people. They usually come to you by serendipity, and that's our criteria. Fernando, do you have anything else to say about that? Not really. I think you explained it wonderfully. 2 more questions. What are the most important lessons you have learned during this time when you have gone so deeply into commodity investment? Well, you learn a lot from your mistakes, don't you? And we've learned plenty, not only from our mistakes. But in general terms, lessons learned, well, I'll mention 3. It's better multi-mine than single mine, but very few mines are very profitable. And this is very important. Of course, capital allocation is key in the mining industry. And it's very difficult to find full, good management teams. I believe those are the 2 main learnings. And then learning a little bit about each commodity, how supply and demand are structured, substitutes, etc. Fernando, your learnings? Well, there's plenty to learn from mistakes. Investing in companies whose value relies too much on a greenfield project is something we would like to steer away from. It can be tempting because sometimes companies are cheap when you assume that things are going according to plan. And then it turns out that reality is not always what you expected. So when greenfields are important in the valuation, in mining companies, for instance, we don't want to take anything for granted. We want to be very conservative. Yes, that was the case of Raymond River, so yes, you're absolutely right. And one last question. What are the differential factors vis-a-vis other equity managers beating benchmarks with long-term success? Well, differentiating factors, I'm not so sure. I believe that what matters is what makes us different from those who don't beat the market, right? Each manager have their own strategies. We talk a lot to American or Asian or European managers who have beat the market. I will later ask Fernando for his opinion, but I believe that the basic thing that makes us different, not necessarily better, is that we know what we don't know. We're experts in saying, I don't know. We do not go into things we do not understand. We try to do just a few things, but we do them well. And I believe that the Austrian School of Economics has been very helpful for all of us. That doesn't make us better than David Einhorn or Mario Civelli, people who have been generating good yield for over 20 years. It just makes us different from those who don't beat the market. Fernando, anything to say about that? I don't really know what makes us different. Well, the kind of, I believe it's up to you to say how good managers we are, how good we are at managing. Well, since that was the last question, we continue to appreciate your trust during hard times. There's not much we could do without that trust. We will continue to work for you. We thank you for trusting us during difficult times, and we're inviting the Azvalor team up to the podium. All those people you cannot see and who play such an important role in what we do. Thank you.